SK Hynix costs $125 in Seoul, $163 on the Nasdaq. Same company, same day, same shares. That gap has been open for 6 weeks. There is a trade that should close it. And the reason it doesn't isn't the one everybody quotes. So by the end, you'll have a fair value for SK Hynix and you'll know which of those two prices is actually worth paying. Because both of those prices are claims on the same stock sitting in Busan. Not two versions of SK Hynix, the same shares. What trades in New York is the ADR, a receipt for them. And the conversion is fixed. One ADR is 1/10 of one Korean common share. That's written in the offering SK Hynix filed with the SEC in July. So let's do the calculation. Seoul closed at 1,730,000 won. Divide by 10 to get the value of the ADR and convert 1,382 won to the dollar. You get 125.2. The Nasdaq wanted 163. 30% more for an identical stake in the same company with identical earnings. But one day is just noise, so here is every week since the listing. Day 1 of the listing was the 10th of July, and the US ADR actually opened at 3% discount to the price in Korea. A week later, it was almost 25% more expensive. By the 24th, 34%. And now, 6 weeks after the listing, it still sits at 30% premium. Now, you might think that this is the time difference. Seoul closes 7 hours before New York opens, so you are comparing a stale price against a live one. Except that the ADR trades in Frankfurt too, and Frankfurt overlaps with New York's opening hours. But here we have the same gap, so it isn't the clock. Free money doesn't sit in plain sight for 6 weeks. So somebody should have closed this. The trade is simple enough that any first-year analyst could run it. Short the Nasdaq ADR at 163, buy the stock in Seoul at 125, hand your Korean shares to the depository bank, take back American depository shares and use those to close the short again. And just like that, 30% gains locked, without any real exposure to SK Hynix at all. But you can't do the third step here. Every ADR program has a ceiling on how many ADS can exist, and SK Hynix's is full. The number you might see quoted for the ceiling is 25% of original shares. But that number is actually wrong. 25% is what the company registered with the SEC. And that's a custody volume. The maximum size of the container, not a limit on conversions. The number that limits the ADS is 2.5%. And it's not obvious at first. I had to go looking for it because it's not in the filings. But in July, the president of the Korean Security Depository said the conversion is capped at 2.5%. And the limit is set by the issuer, SK Hynix. And that expanding it is SK Hynix decision, not the depositories, not Citibank's. So the thing standing between you and a 30% arbitrage isn't a law. It's a company policy. And on the SEC side, the room is actually already there. SK Hynix registered 1.78 billion depository shares. But it has only issued 178 million. 9 times the current ADS supply is already approved. The paperwork is done, but they are sitting unused. And what you are paying the 30% premium for is actually the worst version of the stock, for 3 reasons. You don't get a vote, not directly. The shares are Citibank's to vote. You can send instructions and wait. You also pay fees the sole holder doesn't. Citibank charges on dividend distributions and charges again if you ever cancel your receipts to take the real shares. And then the price itself. 125 in Seoul, 163 on the Nasdaq. You still get the same claim on the same earnings, the same dividends, and in general the same company. But everywhere else, the Nasdaq listing is worse than the Korean one. So you are paying a premium for the weaker claim on the same business. That only makes sense if the business is worth owning at any price. Now, you could argue that if that premium is permanent, you don't lose anything. 30% going in, 30% back from the next buyer on the way out. Expensive, yes, but essentially it wouldn't matter. And this happened before. TSMC's ADRs have traded above its Taipei shares for 3 decades. Sometimes 2%, sometimes over 100. That gap has outlived entire semiconductor cycles. But look at why. TSMC's ceiling is the same mechanism. A cap on how many receipts can exist, and new ones only when old ones are cancelled. The difference is who sets it. In Taiwan, that's the financial regulator, and it has no reason to move. In SK Hynix case, the cap isn't from a regulator. It's a line in the company policy, so the company can rewrite it at any time. Right now, they probably won't, because in July they sold 39.9 trillion won of new shares to American investors at the premium price. But last week they announced 40 trillion won of buybacks in Seoul, at the cheap price. Now, I'm not going to tell you that that was the plan all along, but it's what happened. And a company retiring its own shares isn't likely to throw more of them onto the Nasdaq. So the premium only holds because SK Hynix doesn't feel like ending it. But they can close this whenever it suits them. And you get nothing for carrying the risk. And the incentive isn't fixed either. If the premium stays where it is and SK Hynix wants capital again, issuing new ADS is the easiest capital they will ever get. So the thing that is holding this price and the premium up is actually the same thing that would benefit the most from knocking it down. Now, if you want to understand the mechanics behind a stock price rather than just the headlines, subscribe. I post up to 2 of these deep dives every single week. And I would like to know what you think. Would you pay 30% more for a Nasdaq ticker? Let me know in the comments. What nobody would do is pay a 30% premium for a bad company though. So let's look at their moat. For 13 years, the bottom layer of every high bandwidth memory stack was built on a memory process. With the new HBM4, it isn't anymore. The bottom layer is the base die, the controller that talks to the processor. At HBM4 speeds, it needs a logic process, and SK Hynix doesn't have one. So they partner with TSMC. This means the memory is now built against the same TSMC packaging that Nvidia and AMD already make the chips on. Samsung is doing it in-house on their own 4nm line. That's a real advantage for SK Hynix, and it's structural. It also shows in the market share. SK Hynix ships more HBM stacks than anyone else, roughly half of the total market. The other advantage was yield, but that one has been declining this year. In February, Samsung's HBM4 yield was reported under 60%. By August, around 80%. 4 months ahead of their own plan. With that, they have largely closed the gap to SK Hynix that is sitting around 82%. So, as of today, both companies are roughly on the same yield level. And Samsung started the mass production for HBM4 even before SK Hynix did. TrendForce now has Samsung's HBM4 market share rising this year, with SK Hynix shrinking on qualification delays. So the package advantage is real and structural, but the yield advantage isn't there anymore. But this still leaves a record 60 trillion won of operating profit in a single quarter. And this operating profit comes from 79.3 trillion of revenue, a 76% operating margin. That's also the real number. It's what the memory business earned before anything else gets added to it. And something does get added from time to time. The 94 trillion won record profit you might have seen quoted includes about 33 trillion of investment gains on their stake in Kioxia, a Japanese flash memory business they have owned a piece of since 2018. Real money, just not the memory business, and not repeating next quarter. So let's just value the memory business. Their free cash flow margin hit 48.5% last quarter. The quarter before that, 31.6%. Before that, 26.6%. And for the 6 quarters running up to those, the company set between 20 and 25%. For my discounted cash flow model, I didn't just use the last quarter. I used the unlevered free cash flow from the last 12 months, 50.8 trillion won. the cash the real business throws off before any financing. Now, analyst consensus has the revenue growing from 349 trillion this year to 601 trillion in 2028. I am growing free cash flow at 15% a year against that. So the revenue nearly doubles between this year and 2028, but my free cash flow assumption is about 40%. That basically means that I believe that the memory cycle will come to an end and that a company selling 3 times as much memory as today converts far less of their revenue into cash. Or, in other words, I don't believe that the AI supercycle will last forever. With these assumptions, my fair value lands at 1,705,000 won a share. Seoul closed at 1,730,000. So on my conservative assumptions that I intentionally chose to be harsh, the Seoul listing is about fairly valued. Not cheap, but also not expensive. And it stays roughly fairly valued even if we move my input values a bit. Move the discount rate a point either way, or move the terminal value growth half a point, and you are still landing with a 10% of where it trades today. But let's also turn this around. Instead of asking what the stock is worth, let's ask what the price already implies. And in Seoul, the stock needs the free cash flow compounding at 15.4%. Now, when we use the Nasdaq price up here, and I just used today's exchange rate and calculated the price in won for that, everything else is the same, and the same stock needs 22.7% growth for the next 5 years to be worth the price. That's the same company with the same cash flows on the same day. But the buyer on the Nasdaq has to believe in about 48% more growth just to break even. Now, one thing before we get to what this means for your portfolio. The assumption carrying this entire model isn't my 15%. It's consensus revenue nearly doubling by 2028. If that is wrong, both listings are expensive and the cheaper one is only cheaper by comparison. Now, on the Nasdaq, the difference between the fair value and the current price is almost 25% compared to about fairly valued in Korea. In dollar and accounted for the 10:1 ADR to stock ratio, the fair value of the Nasdaq listing is 123.4, which makes the Nasdaq listing a hard no. Now, there are 3 specific things that I watch and that could affect my investment thesis. The one that matters most is a board resolution raising the ADR issuance limit. It's the single observable event that would end this whole trade. The SEC side is already cleared. 1.6 billion receipts are registered and largely unused, and the July deal went from board resolution to closing in just 20 days. If this comes, the premium would collapse on the ADR holder, but the stock in Seoul wouldn't even feel it. Then I would also watch the Q3 results in October. I would especially watch the free cash flow margin direction because this is the whole thesis. If it stays near the 20% floor through to 2028, the fair value is a multiple of today's price. But as soon as the free cash flow margin deteriorates or they miss the revenue expectation, both listings are expensive. Now, the last one wasn't even on my list a week ago. The labor talks. SK Hynix management and the union have failed to reach an agreement in the 5th round of discussions. The fight is over profit sharing. The management wants more than half of it paid in treasury shares, locked up for the next decade. That would essentially mean that they would hand parts of the buyback back to their employees. Same shares, just in the opposite direction. And all that internal fighting is going on while Samsung is attacking their market share. Now, nothing is scheduled and nothing is broken yet. But that's the nearest dated risk, while everything else is still months or even years away. Now, if you want to buy the shares without paying the premium, the stocks in Korea are reachable. Interactive Brokers has access to Korea for US and European retail investors, against a 0.2% Korean transaction tax. Fidelity, Trade Republic, and Scalable don't offer Korea though. So now you have the price I'd pay, the price I wouldn't, and the things that would change my mind. Now I'm interested. Would you pay the 30% premium for the convenience of a Nasdaq listing? I know that some of you would, and I would really like to hear the reasons why. And if you would like to know why Nvidia made Micron look cheap and why history says that the stock might correct soon, watch this video next. And of course, this is no financial advice, so please, before investing, do your own research and only use this video as a starting point for your own analysis. That being said, thank you so much for watching, guys, and see you in the next video.